started, some housekeeping items. Options involve risks and are not suitable for everyone. As a matter of fact, there is a document called the Characteristics and Risks of Standardized Options. For those of you that have been trading options for a while, you'll know that this is a document that you acknowledge the receipt and understanding of when you open your options account. The guide, also known as the Options Disclosure Document, or ODD, has been revised and consolidated for 2022. As a matter of fact, the document came out towards the end of 2021. If you'd like a copy of that document, you can find it on our website, optionseducation.org, or you can contact your broker for a physical copy. In addition, to keep things simple, some of the examples that we're going to be using, we're not going to include any of the real-world costs, such as commissions or fees, taxes, things of that nature. And then again, any of those strategies and examples that we do discuss are simply for educational purposes. Now, for those of you that are new to options, you're probably also new to OIC, the Options Industry Council. We are a free industry resource. We are unbiased and professional in our presentation of options education. There's no product that we have to sell. There's no stock that we're trying to get people to invest in. We simply want people to know what it is that they're getting into and understanding the risks and rewards of trading options. That education is provided mainly on our website, optionseducation.org, where we have online courses, podcasts, videos, and webinars. And then the pride of OIC is our investor education team. We've got Ken and Roma on the line as well, answering your questions as they come in. So if you do have a question during today's presentation and that question pertains to the presentation, certainly feel free to shoot that to us, and Ken and Roma will be responding to you in real time. Any questions that we don't get during this presentation, we'll try to address at the end during the Q&A, or our investor education team will respond to each and every question, as well as each and every comment that you leave on the survey following the conclusion of today's presentation. Now, typically this is a slide that, for those of you that have been with OIC for a while, you're likely used to seeing this. It's something that I've been skipping over on my presentations. However, I felt it relevant at the beginning of the year to include here. This is the last 21 years of options in terms of contract volume. And the reason I wanted to touch on this for just a bit is because 2021 was a record year for options traders in terms of the number of contracts that changed hands between buyers and sellers. Just shy of 10 billion option contracts were cleared by OCC, which far surpassed the record of just under 8 billion contracts the year before. So 2021, a banner year in terms of trading options. And the reason I wanted to bring that to the forefront is the more people that are getting into options, the more education OIC feels is needed to make sure that people understand, again, what it is that they're getting themselves into and the risks and rewards of trading options. So if you're new to options, as you can tell by 2021 volume, you're certainly not alone. A lot of people are jumping into the pool with you, getting their feet wet, and we're hoping that today's presentation goes a long way in terms of helping you understand this incredible and flexible investment vehicle. So with that in mind, what is it we're going to talk about today? Well, we're going to define what options are, and as I had mentioned, the flexibility of those products. We're going to focus on the two types of options, calls and puts, and then we're going to do a high-level overview of some basic strategies, as well as the exercise and assignment process, and finish things up with Q&A. As I mentioned before, you can download a copy of these slides The bottom center of your console, there is a resource list. And I want you to be sure to download these slides because especially when we get to the basic strategies, we're going to do, as I've mentioned, a very high-level overview. The slide is going to be very complicated to some of you to understand. So having that in front of you or having that for you to review as you watch the replay will certainly be something important for you. So let's go ahead and get into it. Options defined. What are they and why do we use them? At the very base level, options is simply a contract. And just like any other contract, it confers rights and obligations to the buyer and the seller. A buyer has the right to buy or sell an underlying asset, and the seller has that obligation to buy or sell that underlying asset. So that underlying asset, when we're talking about options, is going to be shares of stock or the rights of an index, for example. But in a nutshell, in its simplest form, an option is the buyer has the right and the seller has the obligation to buy or sell a specific asset at a specific strike price or at a specified price, which we call the strike price. So that's a term that you'll want to know prior to the expiration of the contract, also known as the expiration date. So just like any other contract, buyers have rights, sellers have obligations, and the terms of those contracts are specified in terms of the strike price, which is the price at which the buyer or seller has the right or obligation to buy or sell those shares, and up until a certain point of time. Just like any other contract, an option contract has a life date, a shelf life. So why do we use options? Well, this goes somewhat to the flexibility of options. Options give us more ways to implement our market research and more ways to target a variety of our investment objectives, such as risk reduction, income generation, stock acquisition, speculation, et cetera. What options really offer us is flexibility, that if you're buying or selling stock, we've got limited choices. If you're buying stock, then you want that stock price to go up. You're bullish. If you're selling stock, you want that price to go down, and you're bearish. The problem is, without options, is twofold. For example, let's say you're bullish on a stock, that's going to require a capital outlay, right? You're going to need to buy those shares of stock. But what if you're bullish on a stock and you don't want to spend money and actually you're looking to generate income? Well, with just shares of stock, you might not be able to do that. Or if you're bearish on a stock where you're selling that stock, you've got unlimited risk. Theoretically, the price of the stock can go to infinity. And certainly with some of these, with some of these meme stocks that we saw in 2021, while they didn't go to infinity, they certainly increased at unprecedented levels. And if you were short that stock, well, then 2021 probably didn't treat you very well. So without options, there's really only two things that you can do when it comes to stock. You can either buy or sell it. With options, we've got a myriad of choices. We could take a bullish approach and we can collect income. We can use options to mitigate our risk. Say we already have some stock holdings and we want to protect that stock in the event of a market downturn. Maybe there is a stock that you've been watching and really isn't moving at all. It's trading sideways, as we would call it, or maybe range bound. If you owned that stock and it was stuck between $50 and $51 for the entire year, that's not going to be a very profitable investment for you, and you're going to be leaving a lot of money on the table in terms of other investments or that opportunity cost that you're missing out on. With options, you can take advantage of that range-bound trading, that sideways trading, and generate some profit. So options give us the flexibility to do all sorts of things with our investment, whether it's generating income, mitigating the risk that we have. We can even acquire stock at below current market prices, and we can speculate. You think that the stock is going to, go up, you can either buy the shares of stock and outlay thousands of dollars in the hopes that your forecast comes true, or you can possibly buy an option, and we'll talk about that in just a moment, buy a call option and hopefully generate not only a larger return in terms of a percentage, but have significantly less risk as well. So options give us the flexibility to accomplish a number of our investment objectives, and let's go ahead and see exactly how that's going to work. So the two types of options are calls and puts. I had mentioned earlier that typically we had talked about buyers have rights and sellers have obligations to buy or sell a specific security. With equity options or ETFs as well, ETFs are exchange-traded funds, that underlying asset is typically going to be 100 shares of stock. So if I am buying a call, for example, remember buyers have rights. If I am buying a call, I have the right to buy that stock, to buy 100 shares of stock, XYZ, let's say, at a specific price within a specific period of time. If I'm going to be buying a call, I am bullish. I think that stock is going to increase in value. Not only do I think that it's going to increase in value, but I need it to increase in value. I need that stock movement. And the reason being is this. There's a concept called time decay, and this is something a little bit more advanced. We're going to be talking about it a little bit more in the upcoming webinars next month and the month thereafter. But the gist of it, if you will, is just like any other contract. Remember, we had said that there is it's got a lifespan, right? An option may be good for a week. It may be good for a month. It may be good for a year before it expires. Now, as that time shortens, as we approach the end of that week, the end of that month period, or the end of that year period, the option is going to be worth less than it was initially, all things considered, all things being equal, I should say. So if I've got the right to buy stock, I buy a $50 strike call. So I've got the right to buy stock for $50. If that option is going to be expiring in the next few minutes, then the likelihood of that option having any value is significantly less than the likelihood of that option having value a week previous. Now, what I mean by that is the shorter the time frame, the less likelihood is for that contract to finish what we call in the money. And in the money is simply saying that the option has value based on where that stock price is. If stock is trading $50 and I have a call with a $49 strike, I've got the right to buy stock at $49, then inherently that option is going to be worth $1, right? Now, if I go out with that option, say a month from now, I am basically buying myself time to realize a value of that contract between now and expiration. And the shorter that time frame, the less it's going to be worth. So as each day ticks by, the value of that contract is going to decline. It's going to decay. So that's what we mean by time decay. And again, you can go on our website. We talk about the option Greeks, which is basically theoretical pricing components that help us to determine the value of the option. And we talk about time decay. So you can get some of that information on our website or past presentations that we've done. It's a little bit more complex than we're going to get into right now. But the point being is when you buy a call, you need that stock to move somewhere. If the stock doesn't move at all, or if the stock goes down, then you're going to lose money on that trade. So we're bullish on the underlying when we buy calls. We need that stock to move. Typically, we need that stock to increase in value. When we sell calls, now that's going to create an obligation for the seller. They are going to be obligated to sell that stock, again, at that strike price within a specific period of time. Now, there are two different types of call sellers, basically. The first type and the most common already owns those shares. So if I own 100 shares of XYZ, and this is a strategy known as a covered call, and we'll explain that a little bit later in today's session. If I own 100 shares of XYZ, I could sell options against that stock to generate additional premiums. Again, that's called a covered call. So while I'm selling call options, I have the underlying already in my account to cover my trade. The flip side to that is an uncovered call, or what we call a naked call. And what a naked call is you're simply speculating that the stock is going to go down in value. The problem with that, again, as I mentioned, is that theoretically there is no limit to how high that call can go. So there's no upside protection for the investor. Selling calls, just like selling stock short, is pretty much the riskiest investment that an investor can engage in, simply because there is no protection for them. The put side, the other type of option, we have calls, we also have puts. Puts are the opposite to calls. So a put buyer, you have the right to sell that stock. And you might do it if you're speculating because you're bearish on the stock, you think it's going to go down in value. If you already own those shares, you may buy a put to protect those shares because you have the right to sell that stock if the market happens to fall out of bed come Monday morning. And you, as a put buyer, now you've got the right to sell those shares at the strike price. So again, let's look at a hypothetical example. You own stock at $100 a share. You're worried that the market is going to make a downturn, and you purchase a $98 strike put. So that gives you the right to sell stock. That gives you right to sell your stock at $98 a share. Come Monday morning, you wake up, something happened over the weekend, either with the company or some socioeconomic or political landscape, something happened, and now that stock is trading $90 a share. So with that put, you can simply exercise your put, which is, again, something that we'll cover later today. You can exercise your put and sell those shares at $98, even though they're trading $90 in the market. So that protection aspect is very, very important when it comes to options, because when we talk to investors, especially beginning investors, and we ask them about options, and they tell us that they don't trade options, one of the main reasons that they tell us is because options are too risky. And here's a perfect example of this put that I had just described. It's called a protected put. That put is specifically there to mitigate the risk, to cancel out or to provide protection for the investor should things go south on them. So protected put, one of my favorite strategies. Again, it's something that we'll get into just a little bit later. On the flip side, a put seller has the obligation to buy those shares. Again, here's another strategy where you can generate income while you're waiting for that share price to drop. Stock's trading $100, you like it, but you would rather buy that stock for $95. You can use a short put or sell a put with that $95 strike that obligates you to buy shares at $95. If the stock gets there, then maybe you'll get a chance. I'm sure we've all heard the phrase buy the dip. Now, here's a perfect strategy that people use to buy the dip. It's a way to, in effect, purchase shares below the current stock price, below the current share price. So a put seller has the obligation to buy that stock if they get assigned. It's a way to generate income. If the stock rallies and you're wrong, for example, because you're selling puts, that premium, that money that you collect when you sell that option, that's yours to keep. So that would be in the profit column for you. Here's just a quick way to summarize the rights and obligations of buyers and sellers. If we're talking about calls, the buyer or the holder, another term for buyer is holder. The holder of the call has the right to buy stock at the strike price anytime before expiration. The seller of the call, also known as the writer, has the obligation to deliver those shares at the strike price if they get assigned. On the puts, the opposite to calls, the buyer or the holder of a put has the right to sell stock. The seller or the writer of the put has the obligation to buy those shares. So again, not to beat the dead horse, but buyers have rights, sellers have obligations. Now, let's go and talk about some specific strategies and how to make the determination of what it is that we're looking to do. First and foremost, anytime that we make a trade, whether we're buying or selling, we start with a forecast. We want to know what the investor needs to address for themselves is the stock going to go up? Is it going to go down? Is it going to stay the same? How high or how low will it go? And that is going to help you determine a strike price. Remember, the strike price is the price at which you have the right or the obligation to buy or sell those shares. So if I think a $90 stock is going to go up to $100, then I likely would not want to choose a strike price beyond $100. It doesn't do me any good to buy the right to purchase stock for $110 when I only think it's going to go up to $100. So I want to make sure that the strike price that I select falls within that range of my forecast. I also want to know which way that stock is going to go. If stock's going to go up, then I'm going to want a strike price that takes that into an account and choose a strategy that takes that into account. If I think the stock price is going to stay the same, then I'm going to choose a strategy that benefits me or allows me to profit on a stock with a strike price that stays the same. So when we're talking about a strike price, that forecast that we initially incorporate needs to include where the stock is going to go in terms of up, down, or stay the same, and how high or how low it's going to go. Now, the second tier or the second thing that we're going to look at is, well, how long is that going to take? If I think the stock's going to get to 100, is that going to happen in the next week or the next month or the next year? If I think it's going to happen in the next year, then choosing an option strategy that expires in, say, 30 days isn't going to do me any good. So I'm going to want to make sure that that expiration period that I choose incorporates or encapsulates the time that I think is necessary for my forecast to come true. You can see here the saying, time is money. I'm sure that we're all familiar with it. And what that's saying is that the further out we go in terms of an expiration date, meaning from a week to a year, that a contract that gives me the right to buy stock for $100 a share for the next year is going to cost more money than that same contract that allows me to buy the stock for $100 a share for the next 5 days. And it makes sense, right? Look at it from a seller's perspective. I don't know where the stock is going to be a year from now. I certainly don't know where the stock is going to be 2 years from now, but I probably have a better idea where it's going to be next week or even tomorrow. And what that translates is risk. It is much riskier for me as a seller to sell a contract 2 years down the road when I have no idea where that stock is going to be. So as the seller, the fact that I am accepting more risk for those longer dated options, well, then there needs to be a greater amount of reward for me in order to entice me to accept that risk. So whereas an option contract expiring 5 days from now might have a $1 premium attached to it, that same option contract expiring a year from now may cost 10 times as much, because as a seller, I've got significantly more risk. So the point of all of this is that the expiration that you select to coincide with your forecast needs to encapsulate when that forecast is going to come to fruition, and knowing that the more time we purchase, the more it's going to cost. You can also look at it from an insurance perspective, that if I want to protect my portfolio for the next, say, 30 days versus the next 2 years, well, the insurance, that protection for a 2-year plan is going to be significantly more than the protection for a 30-day plan. So time is money. The further we go out, the more it's going to cost. So once we have our forecast, once we have our expiry, then we're going to go ahead and select a strategy. Are we looking to buy calls, or are we looking to buy puts? Are we looking to do something else? Are we looking to sell options? Do we want to maybe take a bullish perspective, but we want it to cost as little as possible, and maybe we engage in a spread trade? I'm sure many of you have heard about debit spreads, where you're buying an expensive option, or I should say buying the more expensive option and selling a less expensive option. Credit spreads, where it's the opposite. You're buying the cheaper option and selling the more expensive option, so you're earning a credit on the trade, and that credit would be viewed as income. So there's different things that we could do. Debit spreads, credit spreads, there's different combinations of buying this leg and selling that leg and doing ratios, et cetera. So options are incredibly complex, but they can also be simple as well. We can simply just buy a call, we can simply buy a put, or we can get as complex as we want, and we can incorporate buying several calls and several puts, et cetera. But once we have that forecast and that expiration, we're going to go ahead and select that strategy. What is it that we're going to do? Now, this is something that people generally don't talk about, but for me, it's one of the most important things about options. Not only do we need to know which strategy we want and time the market appropriately, but is just as important as when to get into the position, it is equally as important to know when to get out of that position. That's our exit strategy. When do we take profits? When do we cut our losses? Some people say that, once I achieve a 50% return on my trade, I'm buying an option, I paid $1 for it. Now it's worth $1.50, so I can sell it for a 50% increase. That's my exit signal. Other people, when it comes to selling options, if I know the most that I can make on this strategy is $2, and now it's worth 75 cents, so I've made more than, I can lock in more than 50% of my profit, that's when I'm going to go ahead and get out of the trade. On the flip side, people look at losses. You invest $100 in an option, maybe you keep it as long as it's worth more than $50. You don't have more than a 50% loss on that trade. once you hit that 50% loss, you're going to go ahead and exit that strategy. Same thing with the sell side. But the point being is sometimes the most difficult trade to make is the one where you lock in a losing position. However, by doing that trade, by executing that trade and locking in that loser, the idea is that you're preventing that loser from getting even bigger and doing even more damage. So start with the forecast, follow with your expiration, select your strategy, as well as an exit strategy, when to get out of that position. And that is really the first few steps into making a trade. And let's look at a couple of these different trades now. For those of you that are brand new, this is going to look maybe a little intimidating for you, but let's see if we can't make head or tails make some sense of this. So this is what we call our profit and loss chart, our risk and reward. This is our profit and loss here on the vertical graph, and this is the stock price on the horizontal. So for an example of buying a call, we're going to buy a 140 strike call for $3.60 premium. Here's where stock is, $140. The 140 strike, that strike price, this is the right at which we have to purchase those shares. And that right is going to cost us $3.60. So if we decided to exercise this contract, and when we exercise, we're exercising our right to buy that stock, we're going to be buying shares at $140, but it's costing us $3.60 to do it. So our break-even point is going to be our strike price plus the premium that we pay. That's $143.60. So that's what we can see right here. Here's our break-even. If stock finishes above $143.60, then that's going to be our profit. If stock finishes below that break-even point, we're going to lose some of that money. We paid $3.60. That option is still going to have some value, but that value is going to be less than $3.60 the closer we get to our strike price. Once we hit that strike price, the option has absolutely no value, and that's where we encounter our maximum loss. So our maximum loss is going to be, let me switch here. Our maximum loss is simply going to be the premium that we pay. When we buy options, the most you can lose is what you put into it. When you sell options, and let me backtrack a second. When you buy options, the most you can lose is what you put into it. That is known as the premium. So the premium is the maximum loss when buying options. When you're selling options, the premium represents the maximum gain of that contract. So if I buy this call, the most I can lose is $3.60. If I were a seller of this call, the most I can make would be $3.60. So buying a call, we buy the 140 strike. Our break-even point is going to be the strike plus our premium, and our maximum loss is going to be that premium paid. Now, I just want to go back a second. At the beginning of the presentation, I mentioned downloading the slides. This is why it's important to download these slides, because for those of you that are new to options, my guess is that this is going to be very difficult for you to understand, even with this visual representation. For a lot of you, it's probably over your head, but by downloading these slides, you can look at it again, try to make some sense of it. And certainly if you have questions, get in touch with our investor education team. Optionseducation.org is our website. Options@theocc.com is our email address. We'd be happy to talk to you and explain this a little bit further for you. So call buying, this is what it looks like. We've got maximum unlimited upside potential with a maximum loss representing the premium that we paid. Now, opposite to buying a call, we can sell a call. And we had talked a little bit earlier about that covered call example. We own 100 shares of stock, and we can sell a call against it to generate some additional income. Without this option, we own 100 shares of stock for $75. If stock drops $1, well, we lost $1. If stock goes up $1, we made $1. But by selling an option against it, we're collecting this extra premium. We're collecting an extra $1.80, or because each option on contract represents 100 shares, we're collecting $180 in the real world. So if the stock doesn't do anything, stays at $75, we've got that $180 premium in our pocket as profit. If stock increases in value, right, our option is going to increase in value as well. By selling this call, we are obligated to sell stock at $80. So anywhere from $75, where stock currently is, to $80, we're going to profit dollar for dollar simply by owning those shares. Stock goes to 80, well, we own stock from 75, so we made $5 on that stock. In addition, we also made that $1.80 when we sold that option. So you can see our maximum, and let's bring this up for you, our maximum profit is going to be $6.80 or $680. We made $5 from the increase in stock from 75 to 80. We made an additional $1.80 from the call that we sold. Now, our break-even price is going to be different than buying the call. It's going to be the opposite. The break-even price is going to be the $75 where we own the stock minus that $1.80 that we collected when we sold the option. And the reason being is we bought stock for 75. We collected a $1.80 premium with this trade. So theoretically, our cost basis is $73.20. So even if stock doesn't go anywhere, that premium is going to help us lower our cost basis and generate some extra income. Now, on the opposite, we've got puts. We can use puts to speculate, as I mentioned, and speculate is simply saying that we think that the stock is going to go down. If that's the case, we are going to profit. Our break-even point is going to be the strike price minus the premium that we paid. And the reason being, if we exercise a $200 strike put, it gives us the right to sell stock at $200 a share. But it's costing us $4 for that right. So theoretically, we're actually selling stock at $196. So that's our break-even point there, $196. If stock finishes below $196, we're going to profit. If stock finishes above $196, we're going to begin losing some of that value that we paid for up until our strike price, at which point the option has no value whatsoever, and we lose our entire $4 investment. That's going to be that maximum loss. And let's go to our protected put. Now, this is the one we talked a little bit earlier, and this is my favorite strategy. And the reason being, again, that risk mitigation. Stock is trading $100. That's where we're long, right? We own shares at $120. Now, maybe we bought the stock initially for $80 a share. So we've got a nice profit. We bought stock for $80. It's now trading $120. We might be looking to lock in some of that profit. We're willing to give a little bit of it back. Maybe that the market, we're expecting a temporary downturn, but we're not expecting it to last. And so we're willing to accept a little bit of a loss on that stock down from the 120. But if things go really, really south, we want to be able to keep some of that profit. So we're going to buy that 100 strike put, which gives us the right to sell stock for $100. And that right is going to cost us $2 a share. So our break-even point is going to be our initial share price plus that premium that we pay. So anything over and above 122, we're going to be profitable because the stock is at 120. If the option expires worthless, well, that's no sweat. Actually, we want that option to expire worthless. We can think of a protective put as an insurance premium. Think about your car, for example, and that if you crash your car, you're not getting the full value of the car. Your insurance company would simply give you, for example, the replacement value, but you're getting something back rather than losing everything, and you're paying premiums each month or every 6 months in order for that protection. And that's the same thing with the protected put. Our maximum loss, now that's going to be a little bit different. It's going to be the difference between the strike price and the stock price plus the premium that we pay. If we're long stock from 120 and we sell it out at $100 when we exercise, well, we're going to lose $20 a share or $2,000 right off the bat. In addition, we're going to lose the $2 or the $200 that we paid for the option contract. So our maximum loss is going to be $2,200 in this example. Now, in hindsight, I probably should have changed the example and make something a little bit more palatable or realistic. Your long stock from 120, maybe we choose a 115 strike put to reduce that maximum loss, but the idea is still the same. The mechanics are still the same, that the protected put gives us the right to unload our shares should things go against us. The idea being is that we're bullish on the stock still. Back to the analogy of the car and the insurance, right? You don't want to crash your car. You don't want to get in a car accident, but just in case you do, you want to make sure that you're protected. Same thing here. We don't want the stock to drop, but just in case it does, we've got some protection afforded by this put. Our next example, we've got a cash secured put. We had talked about buying the dip or purchasing stock below market prices. Currently, right now, stock is trading 146. We sell a 140 put and we collect $2. Now, what that does for us is it gives you a break-even price of 138. So if we are forced to buy stock for 140, we collected $2 up front. So theoretically, we're buying that stock for 138. But keep in mind, our idea, our intent when we did this trade was to buy stock for $140 a share when it was trading 146. So we're buying that dip. We're buying stock below the current share price. So the cash secured put is typically a strategy that people use when they feel that there is going to be a temporary downturn in the market or a temporary downturn in a particular stock, and they want to take advantage of that. Now, the way that everybody takes advantage of those rights and obligations is through the exercise and assignment process. Remember, the buyer has the right to buy stock for a call or sell for a put at the strike price within that expiration time frame, if and only if he or she exercises that contract. And to exercise, what they do is the buyer issues an exercise notice to their trading firm, or the trading firm has a process in place by which the contract automatically gets exercised if it has intrinsic value, what we had talked about earlier, the inherent value of the option contract. If stock is trading $145 a share, and at expiration, I've got a $140 call, so I've got the right to buy stock at $140. It's trading $145 in the market. Inherently, intrinsically, that option is going to have $5 of value. So without me even saying anything, my broker knows that I want to exercise that contract, and they will do it for me automatically, auto exercise process. Now, if I don't want them to exercise that contract for me, I can simply give them a call, shoot them an email, and let them know that for whatever reason, I choose not to exercise my in-the-money contract. Or conversely, I can choose to exercise an out-of-the-money contract, a contract that has no intrinsic value, but for some reason, I want to exercise it. And there's certainly scenarios in which that's a plausible response. But only option buyers can exercise contracts, and the way that it works is this. We've got our investor. They decide to exercise the contract, notify their trading firm, who then notifies their clearing member, who then notifies OCC. OCC is the clearing house, the clearing organization that oversees the option markets in the U.S. with our participant exchanges, those being the NYSE, the CBOE, the NASDAQ, the Miami exchanges, the MIAX, as well as the BOX, and all of the satellite exchanges that those parent exchanges operate. So OCC facilitates that exercise and assignment process in addition to many other services. Now, the flip side to that is assignment. Assignment is the process by which the seller fulfills their obligation. Remember, the seller of a call is obligated to sell stock at the strike price. The seller of a put is obligated to buy stock at that strike price if they are received or if they are assigned an exercise notice. They'll receive that notice from their firm. Only sellers get assigned. Now, here's something interesting, that once the assignment process is complete, it is too late to manage your position. Something that we receive a lot of questions about, saying that I just got assigned on this stock and now I want to close out my option position because I don't want to have to deliver shares. Unfortunately, by the time that assignment notice is received, the process is already complete and it is too late to manage that position. And the way that process works is once OCC gets notified of the intent to exercise, OCC then randomly assigns one of our clearing firms, who then typically randomly assigns one of their trading firms, who then typically randomly assigns an investor that has a short position. So if I am the buyer of an XYZ call and I decide at expiration I want to exercise that contract, I'll notify my trading firm. They will in turn notify OCC. OCC will then find somebody, randomly find an investor that has the opposite side to my contract. Not necessarily the person that sold me that contract to begin with. As a matter of fact, it's very unlikely that it would be the same person. But regardless, they will find somebody that has an open short position opposite to mine, and they will be assigned. So that is going to do it for our intro to options discussion. We've got about 10 minutes left, so I do want to take some Q&A, but let's look at some of the key takeaways that we've had today. Options are contracts that confer rights and obligations upon buyers and sellers. We've got calls and puts. A call buyer has the right to buy stock at the strike price anytime prior to expiration. That right is realized upon exercise of that option. Call sellers are obligated to sell stock if they get assigned, right? They fulfill their obligation. Puts are the opposite. Put buyers have the right to sell stock. Put sellers have the obligation to buy stock. And again, those rights and obligations are realized once exercise and assignment process occurs. Before we get to Q&A, just some contact information here. Our website, optionseducation.org, that's where you'll find the majority of our resources, whether it's online classes, podcast videos, etc. You can also reach out to our investor services team at options@theocc.com. Also on our website, you can live chat with us. So if you're looking for that live interaction, feel free to go ahead and give us a chat during regular business hours. And